Yeah, so I think for sure having a portfolio which has strategies or sectors within it that are uncorrelated or have a low correlation helps to both preserve capital, so benefit performance, diversify risk, and also just generate greater risk adjusted returns. An example of that in our global absolute return bond fund is that we've had a short to emerging market FX versus the dollar, and we had a long to emerging market local currency duration as well in places like Brazil. They're negatively correlated, and the EM local duration part has suffered in March, but actually the short to emerging market FX has benefited performance. So having these two uncorrelated strategies has actually benefited overall fund returns. Yeah, so we believe that a global absolute return bond fund should be or can be a core long-term position that an investor can hold inside a broader multi-sector fixed income portfolio. So not just something that works for a particular environment, actually it can work across all environments. So what does that global absolute return mean? It's a product that's trying to perform across both bull and bear markets. It tries to typically deliver an excess return above a cash index by around 2 to 4%, which is an attractive risk premium for investing in broader global fixed income assets. It's usually well diversified, so that means it pulls investments from a broad, unconstrained landscape. So it could invest in interest rates, it could be credit, structured securities perhaps, emerging markets, and then maybe FX as well as it. So a very broad, unconstrained universe that's not hindered by a benchmark approach. It also typically delivers a low correlation to more traditional fixed income assets. So typically speaking, a global absolute return bond fund might have a low correlation to high yield, emerging markets, or a fairly low to sovereign assets as well. And as well as that, it's a product that can better preserve capital than perhaps a investment grade credit fund can, because it's more flexible. It's able to be outright short duration at the fund level, not just long, or not just say 1 to 2 years relative duration to an index. It has this broad opportunity set to pick from, and it invests more in what we call relative value positions. So it's a position where you sort of have a long and it's hedged versus a short, like for instance a yield curve steepener. And these positions are typically negatively correlated to something that's long risk, like a duration stance. Yeah, I think an issue with these products is that sometimes people get into them too late. They miss the best chunk of returns. I think it's better to hold this fund or strategy as a long-term core asset allocation, so not one that's just held at periods of times. And that's because the product's trying to perform across different cycles, and it can. Typically these products in 2022, for example, delivered small positive returns, and that was a year where, for example, global ag was down -13, -14%. High yield was down similar, even IG credit was down sort of -10, -12%. So this product can work in those environments, but it can also capture positive opportunities when spreads are, tightening or yields are rallying in different markets. So it's one that can really work across a collection of different environments, but that capital preservation basis focus of the fund means it can better limit drawdowns and deliver smooth performance over time. Yeah, so the portfolio overall is defensively positioned. We've got a conservative overall stance. We had that positioning coming into the conflict at the end of February, but we continue to be positioned that way now. We have a long duration bias, so duration is around 3.7 years. That's tilted to asymmetric parts of that market where we think risk adjusted returns are potentially higher. There's limited downside risk. So those markets are, for example, the front of the curve in the US and the UK, and also to New Zealand as well. We're long the yen. We think that the yen has room to appreciate from here. We're mainly long versus the euro. And that is a theme where we are thinking the energy dependency of Europe could mean that the euro could see a little bit more pressure here. It's more likely that the yen is going to be able to act as a bit of risk-off hedge, which is a characteristic that it typically does have, although we've not seen that month to date in March so far. We also prefer duration in emerging markets, again on a very selective basis, and we've used a bit of the sell-off in duration we've seen over the past couple of weeks to buy into that market. And indeed, we've been monetizing positions in areas where we think the fund would be more exposed to a de-escalation headline. So, for example, we had a short to emerging market FX versus the dollar. We also had a short to BTP and OAT spreads. We've seen a lot of deleveraging, so selling in these positions, closing these positions. We've seen BTP spreads rise, and we've seen EMFX as well depreciate. So we've closed those positions, and instead we've recycled that risk into duration, which is a defensive rotation that helps the portfolio to perform in a weaker sentiment backdrop over the 3, 6, 9 month period, but also allows us to better exploit asymmetric returns, given we think a lot of value at this point in time is available in the duration space.